now that the presidential election is over, attention has shifted to the looming fiscal cliff the US faces in the new year. US equity markets showed their concern yesterday by posting their worst daily loss in 5 months. The question facing investors is whether a dividend Congress can get a deal done to avoid another catastrophe like the one that occurred with the debt ceiling. Here to share his views on the subject is Rob Spanjaard, Investment Director at Resco Asset Management. Rob, thanks very much. Let's take one step back and explain what this fiscal cliff actually is.
The fiscal cliff is, I think it's a media creation. The first guy used
You're blaming it on me.
It's the media. It's all your guys' fault. You guys did it. In fact, actually, the first guy who talked about it was Ben Bernanke. He started talking, but I think he did it to kind of warn the guys, listen guys, if you do nothing, we go off the cliff. And it's kind of got a cliff means, and a lot of guys have started to understand it, come 1st of January, the bus goes over the cliff. So it's kind of...
So we're looking at tax increases and spending cuts.
Correct, but as logic would tell you, that takes place over next year. So it's not that something happens on the 1st of January, it's all over. If they haven't done something by the 1st of January, we've got this cliff. So the word cliff it's something that it isn't a correct word. It's more sort of general, gradual downhill.
Sorry, Rob, just to go back, does this cliff stem from the problem? We had the debt ceiling last year, which almost rode the Americans, it rode markets all over the place. It was a very volatile period for markets. They extended the debt ceiling. So they effectively gave, Congress got more credit to go and spend. They got another $1.4 trillion to spend, and now have they spent that money now? And this is the consequence now. If they don't get a deal done, there are these mandatory changes that take place that no one has control over. They've got to cut their expenditure, and they've got to raise taxes. Is this fiscal cliff linked to that debt ceiling problem?
Part of it is that there's about $600 billion that's at play here. So some of it is spending cuts and some of it is tax increases. But at the heart of the problem is they've been spending 3 trillion, round numbers. They've been spending 3 trillion and they've been collecting 2 trillion. So we all know that's not going to carry on, that doesn't carry on for so long. But the reason for that is the crash of 2008, the Great Recession. You had to do something. So what you do, and a sensible thing to do at that stage is you cut your taxes and you boost government spending to take up the slack in the private sector. Now, logically, a lot of that stuff must unwind. And here's where the big difference is. If you actually look what the Republicans think and the Democrats, there actually isn't much difference. So some of it, there's 300 billion, trillion rolls off our tongue so easily these days. There's 300 billion, which is tax increases. Now, those have been termed the Bush tax increases, the Bush tax deductions. Now, Obama himself, they're actually the Obama tax deductions, because he passed them he refreshed all those laws in 2010.
Right.
So they actually physically Obama passed them, not Bush. And the mindset is that a lot of these things, another one, the alternative minimum tax.
But just on that, Obama, those tax cuts, we're talking 300 billion per annum. It saves the fiscus.
Yeah.
All right, so they're giving 300 billion back to taxpayers.
Correct.
He rolled that over because the economy was in such a bad state. He wanted the rich to have more money and theoretically invest and consume so that the economy would kick off. So his idea of rolling those tax cuts was very different to George Bush's when he initiated them.
You know, if you actually look at their positions, they're very similar. I'll give you a good example. If you take death duties, so at the moment the first $5 million of your estate you don't pay death duty on. Now, if the law comes the end of December, that exemption drops to $1 million. So this, you'd think, wow, that's $4 million. But if you actually look what Obama's proposing, he's proposing $3.5 million as the exemption. So 5 million. Now Romney kind of didn't want any death duties. A similar thing on capital gains tax. Obama, capital gains would go from 15% to 20%. That's not a big difference. Okay, Romney wanted no capital gains. He probably would because he's a rich guy, so he want to get rid of the capital gains tax, good old private equity investor. So there actually isn't much difference. And a lot of the stuff, if you take the alternative minimum tax, they've been kicking that can down the road for 12 years. So that's even pre-Bush. And if they did nothing, you'd revert to the tax levels in 2000. Now that tells you how long it's been rolling along.
I want to come back to your blaming the fiscal cliff on the media. Why is the market reacting so dramatically to this terminology if we just made it up?
I think it's become, some of these things get ingrained in people's thinking. I mean, there is one logical explanation, is that there are sensible investors who are saying, look, capital gains is going to go up. It goes from 15 to 20%. Realize your capital gains now, you're going to pay less tax. So that's has some degree is a sensible thing. On top of that, there's a media. If you read a lot of the popular media about it, and that's financial advisors, that's a lot of guys who should know better. There's a kind of hysteria about it. And
well, perhaps the link is, we all know that the US consumer accounts for 70% of that economy's GDP. Is it not just the very simple equation that if the US consumer comes under pressure, GDP will ultimately come under pressure and the economy could regress back into negativity?
Bronwyn, if they did nothing, assuming that they just got into a major bun fight and they did absolutely nothing for the year, you're going to have GDP. It'll have a negative impact of about 4% on GDP this year, which is quite significant. So you go back and you have a negative growth year, which isn't good for the consumer. It'll put them back into recession. But there's no one out there who really believes they're going to do that. In fact, if you look at what the Democrats are proposing and the Republicans, are actually not that far apart.
But, they put this bipartisan committee together to figure out how they were going to close that gap between the amount of money they were receiving and the amount of money
that they were spending.
And that was Simpson Bowles. And it was a great piece of work, and it just got thrown in the dustbin. So why should we believe it this time? And if they don't get the deal done, effectively what's going to happen is there's these forced changes that come into the fiscus, and that's the damage that we're talking about here with this negative 4% GDP growth rate. Is that?
Yeah, the thing is, in the US, the media, particularly in an election year, the media is incredibly polarized. So the kind of conservative media has been trying to paint Obama as a tax and spend liberal. He's going to tax you to death and spend. He's a socialist. And Romney he wants to just hammer the poor and give a tax break to the rich. And you've had this polarized kind of mindset. In reality, you've got a split. You've got the Democrats having the Senate,
right.
Republicans have got the House, and obviously the Democrats have got the presidency. So no one's going to have a power play. Neither party are going to try railroad something through that is only. There's a compromise, and it's in fact nice to have a compromise because they can justify to their constituents, those other guys made us do it. We were there to cut taxes, but hey, we had a compromise, and we can blame Obama, and we're still the good guys. That's if you're a Republican, and obviously the other way around if you're a Democrat.
I want to spend the last couple of minutes chatting about the gold stocks and how they have disappointed fund managers in the South African space in that they have not performed according to a gold bull market. So when is that going to happen? When is the time to buy into these gold stocks because they're going to re-rate?
Bronwyn, we've got in our firm, we've always got a standing joke because that we need a director's resolution to go and buy gold shares because we've kind of done it before, and
you've been waiting for the re-rating.
Well, you see, a lot of it there's a gearing impact, and for listeners' mindset, if your selling prices go up 20% and your costs only go up 10%, and due to the marginal nature of the business, profits could go up 100%, and that's what a lot of fund managers have been hoping for, and that. If you had just gone and invested in the gold price, and we did have some investment just in pure gold ETFs, and that was great, but a lot of us expected you'd have this gearing impact. And what the problem's been is that your costs have just gone up faster than the gold price. So as much as you've had this fantastic gold bull run from about $250 to $1,700, you just haven't made money in gold shares. But if you look, what's different at the moment is if you look 1 year out, 2 years out specifically, you've got a lot of gold shares on forward PEs of about 5 times earnings. Now that's the first time we've seen that type of value. And previously it's been a kind of hope and a wish, if they have great recovery in earnings, we're going to have some value. It's the first time you can actually look at a gold share and you could look at the forward earnings and say, wow, there's some value there.
Rob, the gold shares, we had Chris on yesterday, Chris Hart from Investment Solutions. He was talking about, this gearing effect in the gold companies. It's such a difficult one because the South African gold miners have this almost, they're swimming against the tide in terms of having to go deeper and having greater expenses. The question is, if the gold companies can't run now and see the earnings run now in this macro environment we're in, are they ever going to have a better set of circumstances in which to be able to grow their earnings faster than their expenses?
Yeah, absolutely. That's what we still wrestle with as fund managers. what do you do? That's the dilemma. Are their costs just going to keep going? Can they control them? I mean, we've had a month or two of labour turmoil, but there was something that came out in Goldfields. They got quite good concessions from the unions on working much better shifts. Because down there it can take the guys an hour and a half to get to the coal face,
yeah.
And they've got to 24-hour shifts, longer shifts, which make a significant impact on their costs. So we hear a lot of the negative. The gold miners have been working very hard to get more cost effective. The question, and we're wrestling with it. To be honest, I don't know the answer. That on the one hand, you look at this value, it tempts you, but you've been kind of hurt there before. And
so you haven't bought any gold shares yet?
We haven't bought any yet. We've got it on the. I've been wanting to buy, and the guys have, it's a debate internally.
Well, hopefully you'll let us know when you do pull the trigger and buy those gold stocks. We want notification. Yeah.